You let me know when you want me to roll. All right, sweet.
Okay, try again.
There we go. All right, y'all. All right, guys. So 2024 state of the market. I'm not gonna lie. I was at my dentist today, and they're like, "Yo, we haven't done this in a year." And I was like, "I literally felt like I was here like 2 months ago." And this year has just flown by, as every year does. So, yeah, we're heading into 2024. Absolutely crazy. A lot of things happened this year, right? Almost a World War III. Bitcoin collapse, banks collapse, and we're still breathing and living. And I think that's something to always be grateful for. That none of that stuff actually matters, right? So, what we're going to be going over today, just a couple of things. One, going over some data points. So, kind of looking at where we stand today. Data. Looking at a few big points around interest rates, of course, inflation, market conditions between rents and home prices as well. And then, yeah, I'll talk a little bit about at least my predictions and our own strategies that we're actually implementing right now as well. So, for those who don't know me, I see a lot of ZCU peeps. What up? Brian, what's up? Jen, how we doing? See some people from yesterday. Ryan, what's up? If you don't know me, I'm a real estate investor and a coach. Own about 383 units, 30 million in personal real estate holdings. Retired from corporate America at 29. And yeah, run a group called Zen Coast University and a capital group called Zen Coast Capital. But my really biggest breakthrough in life, my biggest deal I've ever done was getting Jenny, my wife, to say yes to me. So she's a real estate agent, 30 under 30, but she calls the shots. I'm just here, really. So, yeah, that's the intro on us. I love this quote. I saw this recently. Actually, reading the book Tools of Titan again, which I love. If you haven't read that book, good plug there. There's a quote in there that says, "Life isn't about waiting for the storm to pass. It's about learning how to dance in the rain." And I love that because no matter what, there's always going to be something coming up, right? In 2021, I remember people were like, "Oh my God, I can't buy real estate because it's so competitive, blah, blah, blah. Housing prices are so expensive." Okay, sure. This year, it's been, "Oh my God, it's not competitive at all, but interest rates are so high. I can't." There's always going to be some kind of storm coming up, right? And so just adapting, and this quote really basically states, just adapt to where you're at right now, and things will always change, right? And just find the joy in that. So, what we're going to talk about today is, what is a storm? What's the storm that's brewing? How to dance, meaning the strategies, try to keep the theme of the agenda going. And then I'll go over some 2024 predictions and some Q&A. So I'll try to keep it pretty brief today because there's going to be a lot of numbers. I don't want to bore people, but 4 main points I really want to go over. 1, inflation. 2, interest rates, rent growth, and home values. So the inflation target by the Fed, right? The Feds, they've already said this on their website. Their target is 2%. Where are we right now? I mean, we started out in the 9th, I think, in January. We've gone all the way down to 3.24%, right? So core inflation that dictates a lot of things: food, groceries, gas, clothing, eggs, and housing as well, rent and homes as well. But just looking at this, like the Fed's whole game plan was, let me go increase rates, and hopefully inflation will temper. Right. And that's been kind of their core aspect. And it's worked for the most part. Now, again, I think the Fed's job, right, is basically, they're an economic institution that is supposed to help us with jobs, GDP growth, unemployment, and inflation. And they basically target is 2%, we're at 3.24%. But really, the Fed has really kind of come out, and Powell's already said this. They've already made a decision this year to essentially forego employment and banking, right, just to temper inflation. Now, their thought was that if we increase rates at a crazy rate, they even said this out loud, right, and they did it, that they thought that a lot of stuff would collapse, right? Banking would collapse, unemployment would be there. They actually thought that, if you look back in like 2020, end of 2021, when they actually started saying that we're going to start increasing a lot, they thought that a lot of stuff was going to happen. Unemployment was going to go off. There's going to be a mild recession, is kind of what they thought. And what actually happened was they raised rates. They were true to the words there, but what didn't happen was unemployment didn't crack. Real estate didn't crack, which is absolutely crazy. And I think they really have like a very general viewpoint of stuff, like, because right now that's all the power they do have. They only have one tool at their disposal, and their one tool is interest rates. Right? They can move that up and down. They can cause people to tighten up and all that stuff, but they can't control the results of that. They can predict it, but they can't control it. And so the prediction was, that things would spiral out of control. But it hasn't, which is kind of crazy. It's like I feel like we're just kind of waiting, like, oh, things are gonna break, and they just haven't. And you see reports come out year over year, month after month. It's like, oh, guess what? Home prices went up, rent's still going up. Like, what? So, that's what they've been doing. And you can see interest rates right here. That has been an effect that has happened from them raising rates, is that mortgage rates have hit highs, right? I think it's highs been since like the early 2000s, right? And so let's look at where we're at right now. So here's basically the last 35 years of data around interest rates. So you see where we're at right now. We're over here. It's pretty high. It's the highest it's been since probably early 2000s, right? But that doesn't mean it's super, super high either, right? You can always see the 80s and go back to that and say, oh my God, it was like almost 20%, right? Now they had to do that, right? In my opinion, they had to make rates go higher. I don't know if they went too high too fast, or they waited too long to do it. But we did have a lot of time where we had super low interest rates, and we still had a great economy. And that's why things were so inflated, meaning real estate went up in price like crazy. Stocks went up. People were looking at NFTs, things like that, which is crazy. So I'm a big data nerd, right? So I look at this and one thing I see here is that, wow, okay, well, rates have gone up, right? But is it too crazy off the trend of the last, 40 years? A little bit higher, but if that's where we're at, if real estate's still going up and we're at the 7 to 8% rate, I'll take that all day long, right? And so, what it's done so far is that mortgage applications are way down. You see huge cuts in the mortgage industry. I've got a lot of buddies that are mortgage lenders, and they're definitely cut their staff by like 75%. Rates rise on floating debt, so like credit card debt, things like that. That's gone up. It's more expensive to build as well, right? There's less money movement. Can't refinance a lot of trapped equity, right, from people because they can't refi because they don't want to take away their 2.5% rate for an 8% rate. There's an affordability crisis, right? Because what that does now is makes mortgage rates higher, it makes your mortgage higher. Demand lowers, less offers, higher days on market, higher inventory, but overall demand's down, and so is supply, right? And profitability, of course, on new assets gets a lot tighter as well. So you look at cash on cash returns, that's gone down and down and down and down a lot, right? Which is crazy. I love this chart because it kind of shows what monthly rent is versus buying a new home is right now. So in the blue, it's the monthly average mortgage rate in America. And in the red, it's the monthly rental rate in America. And this is the biggest spread we've had. I think it's like a 58% spread of how much it costs to buy a mortgage versus how much it costs to rent. Now, anyone can just shout out, what they think, but based off what you see data-wise, right? It's all about reading data, right? What does that tell you guys? Anyone, just shout it out. Like, what do you think that does for us as real estate investors? Oh, I'll call someone out. I'll do it. I'm crazy like that. Brianna, you're smiling. I gotta go with you. What you got?
I'm sorry. So what are you looking at? Whether it's what it's doing with that the prices have gone up so high and the
So what's the result, right? So
comparison.
if you're looking at this, right, and you're like, all right, like I have this awesome data point. Okay, so monthly cost of a mortgage is blue, in red it's monthly rents. What is a decision? What is like a prediction that you can make from this, a deduction from this?
I mean, I didn't know. I thought the rents were higher than the mortgage went a lot higher than I thought that the actual rent prices did. So I'm a little confused.
Well, yeah, and I think a combination is because one, home prices are still high, right? Like people thought that home prices would come down, but they haven't, right? So home prices are staying high, as well as interest rates have gone up. So now you have to buy a house that's more expensive, and the rates have gone up. Versus, maybe in 2020 or even 2021, the home prices did go up, but the rates were super low still. So it was still in line with rent. Now it's kind of like home prices are still here. And rents and mortgages also come up, but it's staying up, and home prices haven't come down because of the supply issue, right?
Definitely makes it tougher for an investor to make some money.
Yes and no, right? So here's the kind of drawback on that, right? So the positive Okay, let's go with the cons first. So the cons, yes, cost more money to buy a house. Monthly mortgage wise, harder to cash flow. Positive of that is that there's less demand, but also rent. There's going to be a lot more renters, right? And people have seen and said like, oh yeah, rent's starting to slow down a little bit. Well, as supply continues to be an issue, and it is a big issue, that's going to continue to happen, right? Rent's going to continue to creep up and creep up and creep up and creep up, and home prices maybe stay flat, depending on a lot of factors. Mortgage rates having to do a lot with that. Unemployment having to do a lot with that too. It might stay where it's at, right? And because the supply is so low still. So that's just some things to look at. When we look at data points like this, it's just like, oh wow, that's a huge gap. Like people can't afford to buy homes, except for the people that can, right? That maybe have really good jobs and they understand that they can buy maybe at a slight discount, right? But for the most part, that just means to me that there's gonna be a lot more renters.
There's gonna be more renters, but my concern is whether they can afford the much higher rent, if it's sustainable, because it's been such a positive trend for so long. And if not, what's going to happen? Maybe families might have to start moving in with their parents, or say there's more households or something. But I just don't see how this rent is going to be sustainable.
Yeah, it's not sustainable. You're absolutely right. And so you'll see a lot of people that were renting homes, they'll start renting apartments. People that were renting A-class apartments are going to rent B-class apartments. B-class apartments will rent C-class apartments. C-class will rent D-class apartments, right? So there's definitely a pressure of that going down, right? And that's why I was like saying in the middle, like the B's and the C's, because you're in that sandwich, right? Of people always can come down to you, right? I learned this in college. I was a business major in college, and my friend always made fun of me because they were all engineers. That the only thing I learned in business, I would come back and I'd say, I learned about supply and demand. And at the time I thought it was a joke, but now like I'm a little older, a little bit less, little more wiser, just a little bit, but like, it's so true. Everything is supply and demand, right? Like, if there's not enough, if there's so much more demand for renters and not a lot of supply and rents, just by economics, rent goes up, right? If there's not a lot of supply in home prices and not a lot of demand because it's so expensive, what happens to home prices? Home prices also go up, which is crazy. Is it sustainable? Maybe, maybe not. I mean, there's always been talks about governmental intervention, right? I mean, California already does that with rent caps, right? Affordable housing is also an issue too. And it's crazy. I see so many deals in the commercial space, at least, they're called light tech deals, where the government will incentivize, right, to give you a bunch of tax breaks to go develop properties and whatnot. And you'll see a lot of opportunity zones as well. Problem with that is it still costs so much to develop right now. And what does higher interest rates do? It also causes more expensive construction. I talk to brokers all the time, and they're like, dude, like, I have some properties that, in an area that we're at, they're like, dude, like, to be honest, like, no one else is gonna build because the cost to build right now versus the rent they can get is too expensive, right? So there's not gonna be any more supply, and you'll see that here actually. We've I think the U.S. was short already about $5.24 million, 5.24 million homes already in 2020, right? And essentially with higher interest rates, that costs more money not to build. So building has essentially stopped, and people that have bought in the last 3 years, they're not selling at 2.5% rate, 3% rate. So there's definitely a supply issue, right? That's on the horizon, and there's not really an end in sight for that yet. So what can we take from that data point there? And Brianna, I don't know, you got a question. You look like you're about to ask something, but.
No, I don't have a question.
Okay, cool. Yeah, go ahead and put questions as well in the chat, and Annie will let me know if we should ask them. So, I mean, again, the ideology of the Fed right now is they printed way too much money during COVID. I think it was like 40% of the money supply was in there. And now they're basically taking any vehicle to stop spending and cool inflation, right? And take money back out of the market and suck it back out. That's why you see 5% money markets, which is crazy, right? CDs that suck up money, right? Expensive Amex credit card bills at 5%. It's expensive to buy homes, right? So what's happening is just nothing's really happening. A lot less transactions. I mean, we've done a lot less transactions this year than we have in previous years, just based off, you know, the vehicles and things that are out there right now. I think the U.S. in general went from having everyone had like, I think it was the highest amount in people's savings account on average to now one of the lowest amounts, right? So, and mostly that's in the lower class, right? So again, it's, in a way, I look at this and I'm like, damn, it kind of, you know, as a human being, I'm like, it kind of sucks because it makes the United States become a nation of two halves, right? A shrinking middle class where a lot of people that own assets, you know, are still getting a lot of wealth, and the people that are not, they're getting sucked out to dry, right? And so I always kind of say there's that line in the sand, like, you know, what you know, I think we're all grateful to be on this call to even talk about investing, but like, what line in the sand do you want to be part of, right? The ones that have assets and can grow, or the ones that are going to consistently get sucked out and not be able to buy a house ever, right? That's an interesting proposition. And you can see here, like, supply, here's literally the supply levels of single family homes since 2019. I mean, you'll see December, I think this goes into October. So October to October, this is October 2023. Let's go to 2019. October is around here. So we're still a lot lower supply wise in 2019. And on average for the year, you can see it's still on average a lot lower, even than 2022 and 2021, when there was also really low supply in general. So fundamentally, the biggest thing that I look at right now is like, wow, there's just not a lot of supply in general. As an investor, you can even ask that yourself, like, yeah, like not a lot of people are selling. Like, I'm just looking at any deal that can work, and you know, there's not many of them, right? Or not as many of them. So it's really interesting, right? So again, just data points to look at and to think about. Look at that already. So what that means is crazy, is home prices still went up this year on average nationally, 3% growth. And it's not because of interest rates, right? It's literally a factor of supply, and people that still, I mean, people are, guess what, still buying because they just got married, they have a family, they, you know, they want bigger spaces and stuff. Like, people are still buying because of that, right? And supply is low. So again, you're still getting, you know, multiple offers. Maybe it's not 10 offers that are non-contingent, but you're getting 3 offers close to your listing price. Demand's uncertain. Again, home prices are 58% higher than rents. So, you know, more people are renters. And so what I find from the appreciation rates, and again, you'll see, you know, Q1 of 2022 was part of our peak, but 20% appreciation rates. That's unheard of. That is absolutely unheard of. When I first started in real estate, I would underwrite 3% on a conservative basis. So what we're going toward is just normal levels of appreciation, right? This is just how it is, right? It's not like, you know, GameStop where you'll get like 500%. You know, that's not how real estate works. It's a slow and steady long-term thing, and that's what I love about it, right? Even the worst times, we're still getting 3.2%, right? So, you know, that's called dancing in the storm right there. And here's the rental price. So here's the trend. So right now, it's still been going up. It's been going up forever, right? And you look at the trend from the 1940s on. It's maybe gone up a lot, you know, from, you know, see kind of a lip here, kind of level out in 2020 a little bit, in 2021, hit a nice little thing, and maybe it's starting to slow down a little bit, sure. Again, like rent trends, I saw people underwriting deals at like 15% rent increases year over year. That is not sustainable, right? What is sustainable is like 2%, 3%. That's sustainable. That's normal, right? So, you know, if you guys are ever looking, you know, at syndication deals, and you see, and I've seen this, I saw this a lot during 2021. I saw a lot of people underwrite 15, 20% rent increases. And I'm like, okay, all right, like that's not conservative at all. And they're like, oh yeah, we're underwriting conservative. That's not conservative, right? So 3%, you know, that would be a normal rate. Anything below that, that's conservative. So again, you know, just based on data trends, rent is still, you know, going up, flattening out a little more for sure, because of what Annie said. Affordability is definitely going down, and it has definitely been going down. But crazy thing, and one stat to actually watch that I didn't put on here is unemployment, right? Unemployment is holding steady. I think it's at 3.49% or something like that. It's pretty low, which is crazy. Now, if that number starts to take a little higher and higher and higher, you're going to see rent drop, right? And that would be, you know, that would be a trigger there. But so far, that hasn't happened. But I say all those data points, and we talk about all this, you know, predictions and blah, 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 right? But to be honest, it doesn't really matter. Why? Because everyone on this call should be or is a long-term investor. And guess what? That's what we are too. I don't give a crap when I'm buying a deal, because I know that in the long term, if I hold it for a long time, I'm gonna be fine. Decade-wide, decade medium home value, every decade it's gone up. You can see in the 40s, which is crazy to see. The average medium home price was $2,900, which is absolutely insane. At the end of that decade, 1949, it was $7,300, so 150% change, which is crazy, which is high there. The 50s, same thing, 63% change. In the 60s, and 91% change. In the 70s, 178% change. In the 80s, 94. In the 90s, 25. And the 2000s, 35. And 2010, 48. And then 20 to 2022 was 24. Now, even in the worst real estate crash of all time, which I would say was the 2000s, right? 08, 09. And he also had the dot-com bubble there that didn't really affect real estate, but you know, it was a bad economic time for people. There was still a 35% increase in median home price, right? So I always look at that. Anytime I feel down, I'm like, oh man, my asset price is deflated this year a little bit. Oh man. I'm like, all right, well, it doesn't matter. I'm not selling this year. I'm not even selling next year, right? I'm probably gonna hold this for the rest of my freaking life. So, you know, if you look in that perspective, this always gives me a lot of solace, right? Of like, I'm doing the right thing, you guys are doing the right thing. And all the data points that we talked about before, how scary they look, how uncertain they are, and they are, it doesn't freaking matter if you're a long-term investor. Now, if you're a flipper and you're trying to time the market, okay, maybe you got a gripe to pick, but you know, like flipping is our job, right? So if you're looking to build wealth, you're buying and holding, right? So yeah. So what it all means, it just means that asset holders just get richer over time. So if you can stay in the game, right? So what that means is, and I'll put together a couple of things here. Like one is I think I have 4 principles here. One is just knowledge, right? Knowledge to make your own decisions about stuff. Kind of like looking at that data point and saying, all right, like, you know, all right, if, you know, rent prices are staying flat there and home prices or mortgage prices monthly are so much, okay, maybe there's more renters right now. It's too expensive to buy. So that demand's going to slow down a lot. Like what should be my decision? This is what I'm trying to do. Is it still a buying opportunity for me? It probably is, right? But again, that's the own decision to make. And I'll tell you kind of my predictions and what we're doing as well. But I'm sick and tired. Like I feel like no matter what, you got to educate yourself so that when these opportunities do come, and I believe they're coming very, very soon, especially in 2024, are you ready to take action or are you not? I can't tell you how many times I've talked to people who are like, oh yeah, I was in 08, 09 and I was so excited. And, you know, and they're like, oh yeah, then, you know, it happened and I didn't know what to do. And then it was 2014 and I was like, you know, I'm not gonna do anything. And they just do nothing, right? Like the number one thing that you can always lean back to is if you have the right knowledge, you'll know when the right opportunities come to you, you can actually take action on it. So prepare. There's so many free resources out there. There's so many good people out there. Like go talk to people, go read stuff, go on YouTube, ask ChatGPT. Actually, don't ask ChatGPT. I've actually heard a lot of wrong things that an AI guy told me, actually, just sidebar here, just for everyone on this call, that ChatGPT, they're like, we're working on an AI model, but the problem we're having with AI is that it'll just keep on lying to people and just like say stuff because it wants an answer and it can't dictate what the right answer is or not. So sidebar on that, don't rely on ChatGPT completely on stuff. So knowledge is power. Principle number 2 is buy right? So, you know, if, you know, you're going on Redfin or you're on the MLS and you're just buying the first deal you see, you're probably not buying it at a discount. So, you know, another principle to use when you're just buying deals is just, you know, buy a discount, right? Buy some kind of value add. If you were on the call yesterday, you know, you probably heard me say, you know, back then my buying criteria is I want to buy a deal that my ARV is double of that purchase price. That's a great criteria. You can also use, you know, I use the NERF formula now too, is can I buy a deal that's 70% or less of my ARV, my after repair value, right? That'll, you know, what that does is it gives you a 30% spread no matter what. So maybe 15% of that goes to rehab. Guess what? You built to 15% of equity right away from that. So just kind of that's an easy back of the napkin math. You know, how I like a deal is in like 20 seconds. I'll just do a quick math actually calculation. The BRRRR calculation is actually even easier. It's ARV times 0.75 minus your rehab costs. That's your maximum available offer that you can buy a deal and potentially get 100% of your capital injection in. So after repair value times 0.75 minus rehab costs, maximum equals maximum available offer. Principle number 3 is define multiple exit strategies. So funny seeing, you know, this right now with a lot of short-term rental people, right? You know, it's like it was such a big thing that happened, and you know, a lot of people got in short-term rentals, but did not identify multiple exit strategies, meaning that, okay, if this doesn't work out as a short-term rental, I get my permit pulled, right? For me, is there another way I can make money on this deal? We own a place here with an ADU that we were Airbnbing, and then the city passed an ordinance saying that we can't Airbnb anymore. And what happened? No, it was all good. We just midterm rented, right? And you know, made some money from that instead. But you know, you don't think about that, then that can be an issue. Even right now, with a lot of bridge debt coming due in commercial, you know, okay, well, if you don't have the interest rates that you need to refi, what is your backup strategy? Right? Is there a backup strategy? And that's where a lot of people don't have one, right? And you know, they're starting to see those deals go back to the bank, or them restructuring the loan, or just throw the keys back at the bank, right? So have multiple exit strategies. And number 4, this one should be so easy to know common sense wise, but people always don't do it. But just cash flow. If you cash flow your deal in the worst time, like let's say you buy a deal cash flows right now and the real estate drops by 10%. Okay, cool. Drops by 10%. I still cash flow every month. My mortgage is still being paid. Guess what? I'll just wait it out. Because you're not selling when it's dropping 10%. That's for the suckers, right? You're selling when it goes back up, right? So for the people in 08, 09, you know, the ones that were in cash flowing, they bought a bunch of properties, and then their properties went down in value, right? And they're like, crap, I can't even pay the mortgage because it's not cash flowing and it's not worth as much of my loan. So I'm just gonna foreclose. Right. But the people that could cash flow, they're just like, all right, cool. Fuck, that sucks, but I'll just wait it out. Right. Wait it out. Oh, it's 2020, 2021 now. Okay, I'm definitely gonna sell now, right? And cash out on that. And they were very happy about that. So cash flow. And then 5 is just don't over leverage. Right? Don't over leverage, meaning that if you got $1,000 in the bank, you shouldn't be buying $1 million property. I say 6 months of reserves, capital reserves is always great to have. I think one of the biggest things I've seen is people don't have enough cap reserves in their deals, that when stuff hits the fan, they can't pay for anything. That's not good. When their debt is a lot more than their net worth, right? They have a lot of bad debt. That's not good either. Like that can take you out. So don't over leverage. Just means, keep an eye on where you're at, how safe the asset is, so that you can make sure that, even in the worst case scenarios, you're going to be okay. Right. And this game it's a simple game. And I remind myself constantly about this, but the game is stay in the game. Don't get knocked out. And if you stay in the game for a long time, you're going to be great. It's really the Warren Buffett technique, right? He's just old as crap, and just made his returns year over year until he's a billionaire, right? Like, I think, he still lives in the same house. He still eats McDonald's every day, which I guess there's something about that because he's like freaking 95 or whatever, and he's eating cheeseburgers every day from McDonald's. Maybe that's spice of life, but it's a very simple game. Long-term, boring, vanilla returns, cash flow, don't over leverage, keep on compounding effective, use the tax strategies if you can, and you'll be a really wealthy middle-aged or old person, and that's an awesome place to be. Cool. So my predictions, guys. So my predictions that you hear so many people talk about rates just getting cut Q1 of next year. I saw a report today. People were like, "Oh, rates are dropping in March next year." Don't bank on that. Don't bank on that. I think for the better of our macro economy, they should keep rates where they're at for the next year and a half. Because guess what? If the Fed is saying, "Hey, our target inflation is 2%," and what they've done is worked and got it down to 2.4% from a 9% in January. if they drop rates 3%, guess what? All that work gone. Right? Real estate's gonna go up like crazy. All that stuff's gonna happen again. So they have to make this the new norm. The norm back in the day, guys, I was getting 5.5% rates on the norm, right? Back then when I first got started. And I was like, that's awesome. That's the norm, right? 3% is not the norm. 8% is not the norm. It's somewhere in the middle, right? But they can't do it fast. And so they're gonna do it slow. And so prediction there is that in 2024, rates will still be 6 to 7%. Right? Which means that if you're buying a primary, you probably get in the 5s for that. We're doing a multifamily deal right now. We're actually got a 5.99%, which is actually crazy. But we did buy a point down. But again, I don't think it's dropping much more than that. I think 6 to 7%. That's kind of where we'll be at. I think people forget too. The government and the Fed, they drop rates when they need to spark the economy. So when they do eventually drop rates, maybe below 5, it's not going to be an economy that's going to be great for that. That means it's going to be high unemployment. That means, unemployment maybe in the 4 or 5% range. It means it's not going to be great, but it will be great for deals when that happens, because a lot of people are going to be in panic, right? There's going to be a lot of distressed assets, but lending will be tough again, right? So do you have access to capital? Do you have a network of people that you can raise capital with and go do deals with? Because, if so, right, I've heard a lot of rumblings about people trying to get funds together, right, of cash, so they can go buy deals for cash, right? Go to the bank and be like, hey, I'll buy that distressed asset for all cash at 20 cents on the dollar. Okay, that might be a great play, right? So again, that goes back to be ready for those opportunities when they come, right? Knowledge is power, but also your network is power as well. So I do think that they will drop rates in 2025 a little bit to 5 to 6%. Again, I don't think it's dropping past that, but I think they'll start to level off, because I think, maybe by end of the next year, we'll see a mild recession, if they even say that. I've heard a lot of rumblings about soft landings and blah, 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 because it's been so resilient. But again, like, I think the thing that may break is that whole housing supply issue, right? Is that if rates stay high, no one's going to build. If no one builds, supply is going to stay down, right? And rates and home prices will stay up as well. And that's actually going to be part of that inflation aspect too, where like they're going to need to get to 2%. And if home prices are going up by like 3% every year, and rents still go up by 3% a year, it's going to be hard to get inflation on 2%, because home supply or housing accounts for a lot of the CPI. So my prediction for next year is that inflation will still be in the 2 to 3% range. I don't think we'll hit that 2, but we'll be in the middle there somewhere. Rates 6 to 7%. I think rent continues to go up because there's more demand. Less people can buy homes that weren't going to buy homes, especially in the B class arena. In the C class arena, I think rents are going to continue to go up there. And in home values, I think that goes up as well. There's just no supply and no end in sight for that, to be honest. So that's our predictions, the things that we're gearing up to do right now. Like networking, like a lot, seeing that we can raise capital to buy deals cash and just hold when those come, because we're starting to see those trickle down into the market right now, a lot of distressed assets. And a lot of them will be restructured by the bank, but those ones that do get through, do you have the operations to do that? So this year we did a lot of work on our operations team. That's why we brought our property management in-house. We're going to continue to leverage that to be like, all right, like we're going to operate everything in-house next year when we buy distressed assets, because those need the most operations. So that's what we're gearing toward is just that aspect of it. Creative financing is big. If you were on the call yesterday, people are just a lot more willing to talk seller financing, right? They're a lot more willing to talk sub 2. So there'll be a lot more of those interesting conversations as well. So again, if you know how to negotiate those and talk through them and get the right terms that are favorable for you, I think you're in great shape as well. So yeah, those are the predictions. And bonus, guys, is go and take action. Right? One of my favorite quotes, actually from one of our students, he said, the only difference between you guys in the people in the chairs versus the people on stage is that they took action. That's it. I'm not smarter than anyone on this call. I'm probably dumber than a lot of people on this call. But the only thing I did is I'm so dumb that I took action. And that's it. Right. So, yep. And if you were with us yesterday, we're doing a challenge, end of year challenge. So just DM me, Sarah challenge. I'll keep you accountable. I think I had a few people reach out yesterday. I'm happy to continue to keep you guys accountable on that. If you want to learn more about Zen Coast University or just need a little bit more support, you can use this scan code here. And happy to chat. So yeah, questions, comments, concerns.
All right, so going back to the interest rate, and this is kind of a question that I keep getting from SARE members. For those who are saying, okay, interest rates are too high, I'm gonna wait when the interest goes back down to the 5s or the 6, where it's more, less scary sounding. So what would you say to those folks who say, I'm gonna wait until maybe next year when the rates drop?
I mean, you can never time the market, no matter what. I mean, like I said, in that decade by decade comparison of median home price, time in the market is better than timing the market. You're never going to be able to time the market, right? Like, because you don't know what you're going to see. And I truly believe that, like, yeah, if rates drop to 5%, even lower than that, then the economy's not in good shape, right? You may lose your job then, right? You're going to buy a house then? No, right? Like, so again, there's a lot of factors to go into that, but I'd say, like, if you're a real estate investor, a true real estate investor, that you're making this part of your commitment of your portfolio of your life, then you should always be looking, because there's always be good deals in a good market or bad market. You just got to find them, and so you got to stay in the game. And so if you just tell yourself you're going to stop looking, that's actually one of my biggest regrets in life. Actually, I think in 2019 I like stopped looking, right? And I was like, I'm tired. I'm like, I want to just chill, and I just stopped, right? And one of my mentors always told me, it's like, you always just want to be looking for deals no matter what, because that one deal can change your life. So.
And I also do want to always remind our viewers that interest rates are not the most important thing. Like, it is important, but if you think about it right now, the rates are higher. If you think about the interest rates dropping down 1%, chances are the price of the home is going to go up significantly. And if you know how to calculate your monthly payments, chances are you might be buying a more expensive house at a lower rate, and it'll still cost you more than what you're paying now at a higher rate, at a discounted price. So tell people is like, have your buy box, have your criteria, learn how to underwrite. If it fits within the criteria that you came up with, then go buy it. So you date the rate, but you marry the house. So what that means is that when the interest rates do go back down later on, you can refinance it to a lower cost so that it lowers your price. But if your underwriting worked when you bought it and it works as a long-term rental, that means when you refinance at a lower rate, you're going to be saving money. The monthly payments are going to be shorter. So don't get so fixated on interest rates. And then there are also ways about interest rates that you can lower. What can they do? They're really freaked out about it.
Wait, say that one more time. What was the question?
There are ways to mitigate the higher interest rates. What are they, and what would you recommend using it now?
Yeah, I mean, there's so many different ways you can mitigate lower interest rates or higher interest rates by, either do creative financing or just understand what other options you have, right? So we were even exploring doing a deal using our whole life cash insurance, right? And say, all right, cool, like I just got my rate for my whole life cash insurance, 5.73%, right? Okay, I could use that rate, right, and buy a house and had a huge discount and cash flow pretty well. Just creative financing. There's seller financing. So we did a deal last year. I think we got like 4.5% rate on a 52 unit seller finance, right? And the biggest thing where people are like, oh, how do you get seller financing deals? It's a very easy answer. You ask for it. Hey, would you be open to seller finance? No? Okay, that's great. You would? Okay. Or what is it? Okay, let me explain it to you, right? So you just gotta ask. You miss 100% of the shots you don't take. There's also sub 2 as well. A lot very popular right now in the sub 2 community, of course. Gray area for sure. But there are legal ways to do it in commercial. It's actually 100% legal to do it, right? In Fannie Freddie loans, because they underwrite the deal, not you. Like, it's actually very legal. Residential, gray area for sure. But that's another way to get deals done. So just remember, guys, it's price and terms in a deal. It's not always about the price you pay. Sometimes it's about the terms you get. If you're on my call yesterday or on this call yesterday, then what I always say is you can't have both. You can have one of them. So you choose, right? If you want your price, then you better give me seller financing or some good terms. All right, you don't want to give me terms, then you better give me this price, right? That's the only two ways I'll do this deal. And if it doesn't work, you walk away. You may fish in the sea.
Right. And for those also who are not ready for subject twos or the negotiation parts because that's a little new to you or feels scary, then for those who qualify for conventional loans, you can also consider like the ARM, the mortgages, like the one that's like you can lock in at a lower rate in the first couple of years and then it goes up because by then you can also do a refi. So there's like a 5-year ARM that you can do, or consider the buy down rates. So meaning you're kind of prepaying your interest rate so that you can have it locked in at a lower cost. So across your loan.
Yeah. So I'm going to add a question to myself on that because I get this question all the time. I just want to address it is, should I get like a short-term rate? Should I buy down a point? Like, what do you think? So the answer I always tell people is it depends on the exit strategy, right? So if you believe that you're going to exit and refi in 2 years, then it's a math equation. It's just a simple math equation. If it costs you a point on the loan, let's say it costs you like $5,000, right? Okay, well, $5,000. What's the difference between your mortgage with a point and mortgage without that percent lower? All right, $20 difference. All right, $20. You're gonna hold it for 3 years. Okay, is that the same, right? And what's that ROI there? So it's a very easy equation, and take the emotion out. It's just a math equation.
Right. Because if you're going to prepay that $5,000, but you're going to sell it in like less than a year or two, you're thinking, oh, interest rates are going down. I'm going to go sell it. Well, you kind of probably losing money on that buy down. So think about your strategies and your exit, your timeline for exit. All right. So the next question I've been ignoring since yesterday, a certain awesome person, Ryan, asked this question. And I was like, you got to wait until tomorrow night. That's how I dangle my carrot in front of you. So last night his question was about your buy box. How has your buy box changed compared to this last year? And pretty much like how are you underwriting now? Now that you feel like there potentially could be a recession or major changes going on.
Yeah, for sure. So I'll give you an evolution of it, right? So in the beginning, my kind of where I was in the middle of cash flow and equity. And I was like, I couldn't decide, so I was in the middle, right? So it was like in 2015 or something. So I would look at like 7% cash on cash was my buy box with the 15% IRR. Now the IRR hasn't changed. 15% IRR is still my cap on where I look at, but the entry cash flow is different now, of course. Where it used to be 7, then I went to 10, right? Then I went to 12. Now I'm like 4, I'm good, right? I'll take that. So it just you change it with the with the equations that you have as well. Our buy box nowadays, I mean, like I'd say 2 years ago, we were primarily just doing bursts, right? So I had to get my capital back out. I had to be able to cash flow after the exit. And I would say in that arena too, 2021, 2022, we were very heavy equity as well. Like, all right, like I want to go for those big equity gains. In my opinion, that's where you create a lot of wealth. Cash flow will get you out of your job fast, but wealth's where you really create, or equity is where you create wealth in the long term. Now I revert back into, all right, well, fundamentals, cash flow, make sure cash flows, right? So right now, make sure cash flows. My 15% IRR bucket is still very, very true. I won't do a deal unless I'm making 50% of my money. And this kind of goes over to our overall strategy. I think, Ryan, this is your question yesterday. 15% IRR basically means you're doubling your money every 5 years, right? So if I know that I want to double my money every 5 years and I want to get to a certain goal by the next amount of years, then I know every deal I need to do has to hit 50%, and everything on top of that is cherry on top. So fundamentals, guys, cash flow, positive, and 50% IRR. I actually, in the beginning, and this is where, depending on what kind of deal you're doing, like we do a lot of apartment complex commercial deals. It is always in like last couple of years, I actually would buy deals that didn't even cash flow from day one. Right. But now I'm changing that again because now I need to, because those were like value add deals. And you had to put a lot of, CapEx costs into it to make sure it did cash flow. Now, right now in this environment, I'm saying, nope, I will only buy deals that cash flow day one. So.
Right. I also agree that something that cash flows, just breaking even is not enough because like if something's wrong, like an AC or the roof, that's a ton of money. And so the cash flow is super important, and then making sure that you have that cash reserves, because the worst situation that you can get yourself in is that if you had to have repairs or like your tenants are not paying and you run out of reserves to continue paying your mortgages and you have to sell it at a loss. There's a lot of shit that can go on that you might not have thought of, that it probably can happen. For example, I bought something about a couple of years ago for like, it was like 8 units, 2 quads next to each other. And as soon as I bought it, these tenants started ganging up on each other and they stopped paying me rent for over 1 full year for 2 properties for all 8 units. I know Jen's mouth is like, ah, but luckily I live in California. I have a W-2 job. I have other rental income supporting it. And so I didn't have to sell it at a loss. But when shit hits the fan, it really does hit the fan and can really affect you. So just to, kind of let everyone know, just to be a little bit more conservative for moving for this year. That's what.
And I imagine those tenants were C-class tenants.
Oh God, yeah. So my personal change of what I did was I thought it was pretty dumb. About 2-3 years ago, I was buying a lot of quads. I bought like 3 quads and then an 8 unit. And yeah, they were all C unit properties that were in cheaper areas. And I was like, oh, the performance looks great. Oh, the numbers look great. Don't believe it. It looks great for a reason, because they're trying to sell shit to you. My shitty part was that it took a really long time to get rid of all the inherited tenants. Yeah, they were all like working class. There was a lot of turnover. It was really costly. So that was a change that I'm doing this year, is buying in nicer areas, as nice as I can afford it, because I can't change the location or the type of people.
Yeah, B till you die, BB.
And Cal, are you putting more money down like this year as compared to last year to kind of, have less debt ratios?
Oh yeah, for sure. Yeah.
Okay.
Yeah, and commercial deals, I mean, don't even talk about not putting at least 40% down right now. So
Gotcha.
40%, I would say actually 35 you could probably get away with, imagine, just based on DSCR, but yeah, a lot more down nowadays. But again, it's kind of on a residential, like I don't want to make it sound like this is out of the norm. In a normal environment, I was putting down 25%, right? So like whatever, I think we're so spoiled from 2021, 2022 that it was like, oh, I can put it on 10%, right? That is not normal. The normal is 25%. So it's going back to normal.
Right. And then like how Calvin actually mentioned about the commercial. So what we're seeing in large multifamily, like the bigger units, is that in the past, people could put down like 25% down payment. But right now, it's even the lenders are unwilling to lend more than like say the 65% LTV, meaning you need way more money than before and a lot more reserves. You might have to put more money into the escrow in order to even be given that loan. And so a lot of people, what happened about 2-3 years ago, when they didn't buy interest rate caps, or they were buying these, the ones where there's like a floating rates, those bridge debts loans. Now those people are the ones that are getting screwed over because they didn't protect themselves. And now they can't afford to refinance from when they bought it at 25 to the 65 LTV. So
I actually want to add something that I didn't have on presentation.
Yeah.
Banks. Let's talk about banks real quick.
Mhm.
Banks are in trouble. And they're going to be in trouble next year. And I think that might be the first thing that pops, is the banking system again, right? It's maybe not the JP Morgan Chases of the world's, right, or the Wells Fargo's of the world, but I'll tell you as much. I work with a lot of regional banks. They're starting to say things that are worrying. No, I mean, they're worrying me as a consumer, but like I'm gonna work for them. Like they've been like the examples. They'll ask you for, hey, would you be able to put more deposits in the bank? That's scary, because how banks work is they can lend out, I think it's like whatever, divide by 0.1 they can lend out, right? So they keep $10 of your $100 and lend out the $90, right? So that's really interesting. They're definitely getting a little more tight on everything, right? Because their investors are getting tired with them. So they're getting tired with everyone. Like I've gotten emails about site visits lately and things like that they never used to do that. So it's very, very interesting, that environment. And what that tells me is that, they got the bonds that they bought that's not worth as much, and they're kind of just chugging along. But now the high interest rates are also cutting their line of revenue, like new revenue too. And that is a scary, I wouldn't call it death spiral, but like I wouldn't be surprised if next year we start to see a lot of small regional banks fail again. So
that one I agree on. Earlier in the year, so I have friends who, or especially our sponsors, there are banks of like US Bank, Chase Bank. And so what we've been seeing is that some of the smaller regional banks have been merging rather than going out of business. And then also
Bank of the West went to BMO, which is crazy. Like,
yep. Then was it the Silicon Valley one got absorbed by Chase, but then
my favorite one was First Republic. First Republic's actually a really good bank.
it was
It's a really good bank,
solid,
and
good
Chase
service.
was like easy. I will buy you guys.
Exactly. But what we're seeing, the thing is that with the conventional rates, because it's so high, it's that that's what they're getting charged by the Federal Reserve, is that there's basically the margin for them to earn money is so low. Like they earn maybe what 1%. Remember, whatever loan we get, they usually have to pay a broker fee about 1%. So what's the profit margin on the banks themselves are so low that if it goes higher, they're pretty much losing money. Or in that situation, or not even if they don't lose money, they're not making any money. Therefore, they're actually going to stop offering loans, and they're going to think of any reason to not give you one. So we're seeing slowdowns for HELOCs. They might not even give that anymore, or refinances. Some big banks have already stopped. And then, so if you do qualify for conventional, they're going to ask you for a shitload of paperwork. So just to like have some random excuse not to give you that loan. The other things if you guys are changing your underwriting, is double check on your insurance fees, because especially in Texas and California and Florida, we've seen huge increases. So whatever, like when you're doing pro forma and you're just asking like, hey, how much have you been paying for? Don't use that number. Go check in with someone, maybe at a broker or something, or even just bump it up a lot higher, because personally my interest rates have almost doubled in Texas and in some of my properties. And so I think that was kind of, and then also your property taxes is to double check the pricing on how your county in wherever you're buying calculates your property taxes, because we've seen huge increases in that in certain states as well. Okay, the next question I have is from AK. When trying to determine ARV and comps, they're so different between two realtors. How does one get an independent appraisal?
Okay, so AK, is this for comps for an appraisal for like a refi, or just for you to understand what the ARV is? Oh, I think you might be on mute.
AK.
Yeah, so basically I'm looking at buying a property. It would be a flipper. The realtor representing the property says, oh, once it's done, it'll be $325. Another realtor says, you'll be lucky if you get $225 for it. That's a big discrepancy between the two. And I'm not sure how much the rehab cost will be. It's actually better on the inside than expected, but it's way worse on the outside than expected. So some modular home. So I have a feeling I could find some real costs that are hidden. So I just don't know where to begin, because like I said, the two realtors are $100K apart.
So here's the easy answer on this. Don't trust either of them. Do your own research, right? Like there's the internet. Go on Redfin, go do your thing, and go look at the comps yourself and say, all right, this is what it actually looks like. This is what I can make it, and this is my ARV comps. Don't rely on other people. But guess what? Most realtors are not investors. They don't even know what they're talking about, right? They're salespeople. So you trust your own process, you trust your own knowledge, right? And you go do your own comps. I never trusted realtors' comps, right? I'll say what I think it is, and I'll ask them, right, for their opinion, and I'll back it up with my own stuff and say, all right, this is what I actually think. Because what you can do when you actually get an appraisal done and stuff, we have appraisal packets that we give people, and I'll actually put the comps that I looked at and said, this is why. And I'll even say, this one has one more bedroom, but mine's nicer, right? Oh, or this one has one less bedroom, and it's over this, and this is why, right? So do your own. You don't have to get a third-party opinion. Get your own opinion on it.
Okay, thanks. Yeah, as it turns out, they basically give me 1 day to put my offer in, and I'm just like, I need more than a day. So just
That is yeah. Don't, again, if I'm trying to rush you in this environment, that's a red flag too. So
I was like, thank you for saying that part. It's like, why are they rushing? It's like the slowest season in the year, and plus interest rates are like at the 9s.
Yeah. Only if they're like a wholesaler, will they be rushing, right? These sound like agents, so it's like two different agents too, which is kind of weird. So I don't know.
So yeah, I got two completely different. So I looked at two different properties. One which was a nice property, one which is a flipper. And so the flipper realtor is saying, oh, you'll get 325 when this is done. The other realtor is like, you'll be lucky at 225. When they look at comps, maybe get 250 possibly, but I just don't know how much the rehab costs will be. I got estimates from one contract about 45,000, but we all know it ends up being a lot more sometimes.
Oh yeah. And what you can do too, man, is you get under contract at a price that works for you of what you think it's going to be with your contingencies and your outs. Then you have a real contractor go there and actually quote it. And when you get the quote from the real contractor, when they actually see the property, I'd add at least 25% contingency at least right on it. So
okay, thank you. Yeah, they actually it was no contingencies, et cetera, because they have another offer. And basically, they showed me the offer, and they let me get it. They would be willing to give it to me for $5,000 more than the offer they had in writing.
I think you go pound sand then. That's what I tell them.
Okay. And then Becca,
I'm getting the hammer.
Yeah. And then Becca asked, is it 6 months of cash reserves on just the rent amount, or how are you planning for like your reserves? How are you calculating the 6 months?
Yep, 6 months on your mortgage on it. So yeah, not your rent amount, just mortgage. Because what you look at it as like, all right, if it was fully empty, and I had to pay the mortgage, could I last 6 months? You'll be able to figure it out in 6 months.
How about your insurance or property taxes? Do you build that in there as well?
Yeah, I would say what are your fixed expenses are for the property. So mortgage, PITI, all that stuff that you have to pay. Keep the house.
Yep. Great. Any other questions, folks? These are really good ones.
I had a question. Calvin, I was just curious. So it seems like everyone's like waiting. When do you think everyone's gonna it's gonna get competitive again? From what you just said, I'm thinking you're thinking there's like not gonna be some sort of crash next year or anything like that. So everyone seems to be renting and waiting, but I'm just curious on when you think the market is gonna get super competitive again.
I mean, so let's look at why the market got really competitive in the first place last time, right? It's because they dropped rates like crazy. So everyone's, wow, this is so cheap. I can go buy a home for really cheap. It's not gonna happen again, right? So it's gonna get competitive slowly again over time, right? And so one thing will have to change, right? And that again, supply, right? Like the Fed's gonna have to give a reason, right, for people to want to transact. Right, meaning that there's got to be introducing more supply. That means rates have to drop, because why would you refi or anything like that? Right now, what the Fed probably didn't look at, because they're not real estate people, is that when they lower rates, that would trap a lot of equity, it would trap a lot of homes, and that fundamentally has to change for it to be competitive again. I don't think that's going to be next year, right? Like I said, that's why it's going to be like a slow drip. It's going to be like a slow burn of real estate. It's just going to continue to slowly gain. Until they can figure out how to fix one of those levers. That probably gonna, in my prediction, again, opinion, not a crystal ball or anything like that, but if unemployment starts to happen and that starts to go up a little bit, then they'll have to spur the economy somehow. And again, interest rates are their only tool, so they'll drop that, and that's when stuff will happen again. A lot of money that was on the sidelines will jump back in. And jump back in. People are still transacting right now. Like, don't get me wrong, people are still doing a lot of deals and stuff. You just have less of those people than before.
Right. Okay.
Yeah.
Cool. Thanks.
Yeah.
And then with your crystal ball, do you see the recession causing foreclosures to come back?
With my 100% guarantee crystal ball that I have, do I see that the recession will cause a housing crash? Is that what you're saying?
Yeah, like foreclosures coming.
Foreclosures coming? No, not necessarily. No, because foreclosures happen when your value of your home is less than your mortgage. Most homes were bought in 2021, 2022. Things doubled in price. So maybe you have a clawback of 20% of your value. Okay, I'm still up 30%, right? Like, so you got a lot, and 30% of value plus your 20% down that you put down. So you're still up 50% of equity before you even consider storing it back at the bank. So I don't think we're in an environment that really is like for foreclosures either. Unless like some catastrophic thing happens, which I don't see anything that would trigger that. So no, I don't think a recession really dictates that. I think it just kind of feeds into the fire of less affordability and more renters again, right? I think we're just becoming a renter nation. I mean, if you look at countries outside the United States, Spain, China, all that stuff, Spain and China and all that stuff, they're all renters in general. Like only 10%, I think, of China even owns property or something like that, which is nuts. So we are starting to become like that. And, on that side of the fence, I want to be an owner, right? Like that's just, what I would like to be. I don't want to rent. So.
And I also very much agree with Calvin. A lot of people say like, oh, there's a recession, there must be foreclosures. I'm going to try and swoop down on foreclosures. The thing is that there's so much differences this time around with the recession compared to 08 and 09. Those were because of subprime loans. They were lending to people who couldn't even afford to get those loans. But now it's a lot more conservative underwriting. They're lending to people who actually qualify. And so like Calvin said, they bought at a higher with down payment. It's better for them to sell because they're still going to have something left rather than going into foreclosure and selling it for pennies on the block. And also at the same time is, yes, we are slowly seeing more foreclosures. We had friends who went into the REO conference a couple months back. So they are seeing more. But the thing is that when they mean more and the number looks like more, but historically, like the total number is still very, very low compared to what we saw like in 08, 09. And those are getting absorbed by investors or even by institutions. So we would probably even never really get to see those. So don't about, I'm going to time the market and buy a foreclosure because you're.
Yeah. I think the more of the story today, at least, is we're going back to normality.
Yes, you're right. This is what's normal.
We're normal foreclosure rates. We're normal because they paused foreclosures in COVID, so none of them happened, right? And so now we're kind of getting back to normalcy. And people that made a lot of money in COVID were like, "What the hell? Like, oh, why can't we just why can't we just have this freaking party forever, right? Like." Yeah, that's just not how it works. So we're going back to normal, right? And that's a good thing, to be honest. It's a good thing for the long run.
And I would say be more careful because I think a lot of especially our SARE members in the last 3 years, they've made good money. They've gotten into real estate, they bought a couple, and now they're thinking, okay, now I want to buy more. But a lot of times they don't understand that what might have worked back then might not, whatever their strategy was that worked back then, it might have just been luck. If you implemented and did the same thing now as you did in the past, you would probably fail. But sometimes they're a little cocky and they don't believe it. So so I was just trying to teach people to move, still continue moving, but be a little bit more educated and have more backup plans and reserves.
Calvin, where do you think like extra inventory is going to come from? Because my thought is it's going to be tight for a long time, because what I've read is most of the people that bought homes in the last few years are like baby boomers. They're just going to hold on to it, transition it well to their kids. So like really a little bit from unemployment, but like I don't see where there's big jump in inventories. I feel like it's just gonna be competitive for a long time. I don't know what you're hearing where inventory is gonna come from. Is the baby boomers dying off? That's still a 10-year.
I mean, you look at the long-term perspective of real estate, it looks great, right?
Yeah.
There's no fundamental flaw in real estate at all. Especially for an investor, because there's not going to be inventory. I mean, maybe something that could change as well as the government starts to implement a lot more incentives for builders and stuff, and you start to see that a little more like on a state level. We were looking in New Mexico building a factory, and they're like, yeah, we'll cover 50% of it, and I'm like, oh, that's cool. So you might start seeing that. Cheaper ways to build. You see the evolutions of like prefab homes. You see the evolution of ADU, right? Especially here in the Bay Area, they do SB9, all that stuff. So they're trying to get more creative around that. Is that gonna introduce a lot of inventory? I don't think so. And the government works very, very slow, and it takes a ripple effect. So Ryan, to your point, man, I don't see a lot of inventory coming to the market anytime soon. So you are in that stuck of a bubble of like, not a bubble, but like you're stuck in that aspect of, if you own real estate, awesome. It's going to continue to grow and grow and grow and grow until, something happens there, which is really down the line still. And it's not even baby boomers either that do it. it's all people on this call, right? Like we're also the problem in a good way, right?
That's
Where
true.
it's like we want to own assets. Like I'm not gonna sell anything that I have at 2%. Like I'm sorry, like thank you, Fed, for allowing me to do that, but I'm not gonna sell either. So you've locked a lot of inventory.
Right, think about the boomers though. Even if they sell, where are they going to live? If they downsize their home, they're gonna have to pay significantly more for a smaller property. It just doesn't make sense. You just might as well
Move to Bali, probably, move to Bali, sell everything, live on the beach.
Probably going to be also like I think your question is going to be very heavily dependent on the elections and the politics that come up, because other ways of lowering it could be allowing immigration, some more workers to come in, or more skilled workers, because like with the pandemic and plus the 08 and 09, even a lot of skilled laborers, they left the industry, those contractors, and they never came back. So even like we have fewer people working, and the materials cost more. It's just all these reasons just doesn't make sense for developers to come back.
Yeah.
Politics. Great. Any other questions, folks? Cool. Awesome. So thank you again, Calvin, for hosting this year's 30-day challenge. So this marks our end of the second class. And then tomorrow night, we'll be having Tony Hung, the CPA dude, to come in to talk to us about how to save money on taxes. Because, hey, if I can't earn as much, well, it'd be nice if I can still save money in other ways through taxes, because I'm going to take it from Uncle Sam and put it back in my wallet. So
ask Tony tomorrow. I've been talking about all day. I just talked to one of his people about a really creative way, actually, which is I can't believe this is even a thing. So little teaser for people tomorrow.
I know, Ryan. That's a huge teaser. All right, and I can tell you that even if you're a W-2 worker, you will be saving a lot, because I followed what he said. I did save like a shitload of money in the last couple of years. So
I had a quick question. So Calvin, which website do you typically use for just tracking open listings? Like, are they your favorite websites?
Open listings, like from MLS, or like off market stuff?
Both. Like off market, I guess you said you just find distressed properties and stuff, but
yeah. So we use a couple things. Obviously, on market stuff, easy. Redfin is my favorite. I mean, people have their own slice of whatever they like, Zillow, Realtor, whatever. I use Redfin. But off market stuff, we pay for a tool called Property Radar. It's similar to like PropStream or things like that. We can look up any house out there, who owns it, what the trust's name is, things like that. You can buy the contact information. So we'll buy. We pay for that, and can see houses across the whole nation.
Got it. Okay. And when you said you did Airbnb, and then there was a law which did not allow you to do Airbnb. So what was your alternate strategy there?
Midterm rentals.
Okay, so that
short-term, midterm, long-term. Yeah.
So midterm rentals is like what does that mean?
Like traveling nurses and corporate. So I'll give you real numbers. It's our ADU. It's like 3,800 square feet. And you might choke on this because I don't know, Boston rents are as high as California rents, but 380 square feet. We actually started long-term renting it. That was the first thing we did. We got 2,200 from that. We then Airbnb'd it. We got $5,000 a month from that. We're like, whoa, that's sick. 380 square feet. And then they canceled that, so we midterm rented it. We get $3,000 a month from that. So.
Awesome.
Oh, I had
Yep.
Oh, I had one quick question. So when you're considering capital expenses over time, so I've been buying like Class C, potentially becoming B property, single family homes in Indianapolis. Now I'm starting to think that is not a good approach. But then if I try to go Class A or B, or if I go if I want to buy something like in Sacramento or something, I'm going to be negative cash flow. So I'm not sure.
So let me reframe that real quick, Becca. So there's Class A and Class B and Class C neighborhoods in Indy too. right? Doesn't mean you gotta
Okay.
come to California, right? So
Yeah.
Sacramento doesn't mean it's there's ghetto parts of Sacramento. I've been there. It's not fun.
Yeah.
Right. And there's really nice parts of Sacramento too, right? So
Yeah.
use it. Every market has an A, B, and C. Think about in the Bay Area here, right? Like you have the Athertons of the world. That's an absolute A, right?
Yeah.
You have like a San Carlos, that might be a B, right? You have EPA, East Palo Alto, that might be a D, you know, like so like there's and there's even in those cities, there's neighborhoods, right, that are really good, really bad. Like South City, you know, a BRRRR, right? That's the nicest neighborhood in South City, right? So you're gonna know those neighborhoods, and your real estate agent are really gotta be the people that really help you out with this, especially if you're not from that area. So in Indy, yeah, I mean, of course, your price point's gonna be different from Indy or Sacramento, but your A, B's, and C's in Indy won't be as crazy of a difference than it is from here to Indy or from Sacramento to Indy. So, yeah.
Okay. I'm also looking at it from a long-term appreciation. Because I've had an Indy home there that it is a Class A. And when I look at that appreciation over the past 10 years, it doesn't come close to, you know, California, Nevada, or Arizona. So I don't know, like, if I should, like.
So two layers to that. Yeah. Two layers to that, right? Obviously, the boom and bust towns, the coasts are the boom and bust towns. The Bostons, the San Franciscos of the world, they go up high, recessions happen, they go down low, right? Indy, Kansas City, slow and steady. You're not gonna see much there, right? So it kind of goes back. I mean, overall strategy, you gotta know if you're going for equity or cash flow, you know, that's gonna dictate where you're gonna be at in general city-wise. And then in that city, how much capex and headaches you want to deal with. That's an A, B, C property. Also vintage, meaning the year they're built, can matter there too.
Okay.
Cool. All right. Those are all those questions. I'm going to also give you guys a heads up if anyone's living in the Bay Area. Calvin and I, we're both in the Bay, so we will be working on more events together in 2024. Maybe we'll do more webinars or something in person. And then also just come and hang out with us and just learn more. We just love to teach and network with everyone. But I want to thank everyone for their time, especially Calvin for giving us all these nuggets of wisdom. And I can't wait to see everyone again tomorrow night. Talk to you soon.
Thanks,
Bye.
Calvin.
Yeah, peace, guys.
Thank you.
Thank you.